All right, everyone. Welcome to the Allied Offset webinar, Law and Carbon Order. I'm Brad Wabacher. I sit on the business development team at Allied Offsets. Today, we're going to be looking at three specific areas of the voluntary carbon market. The first one being around the infrastructure, how credits are generated, issued, transferred, and retired. The second is around digitalization and data and how that's evolving within the carbon markets. And finally, the commoditization of carbon and how that becoming a financial asset could potentially impact where we go from here. A couple of few logistic things to mention before we get going. One, the comment section is open, but please put any questions you may have in the Q&A box. And secondly, this is being recorded and will be available for replay later after the call. So thank you for all of that. Before we get in, I did want to let me share my screen. And we will start by talking a bit about Allied Offsets. So Allied Offsets is the most comprehensive provider of data and analytics in the voluntary carbon market. Our users use our data around price discovery, around project and corporate buyer identification and evaluation, and market forecast, along with a number of other use cases. And today, I'm actually going to use it to set up the conversation we're going to be having. First, we'll look at what is the current activity in the carbon market. So what you have across the top or the issuances year to date, and you can see it's nearly 150 million credits, down just over 3% from last year. Interesting fact, if we would have looked at this number a week ago, issuances were down about 20%, but we had 25 million new issuances last Friday on May 27th. Retirements year to date are up nearly 12%, and this is following on the trend that has happened for the vast majority of this year, being above last year's retirements. And lastly, you see the off-registry CDR purchases, which is up nearly 150%, which again is consistent with what we've seen in the market. At the bottom of the page, you can see a few price charts. So Allied Offsets provides a number of different indices. The two I have here are the Allied Offset 500, which is our broadest indices around prices in the voluntary carbon market, as well as the tradable 20. I think what you can see here is probably what most market participants already know, that prices have trended sideways for the past year and a half or so, with a bit more volatility in 2025. And in the bottom right-hand corner, what you have is sort of the concentration of buyer sectors. And what you can see is that 75% of retirements are actually happening in 6 sectors. So one of the things our conversation will bring out today is how do we potentially expand those buyer sectors and the number of buyers participating in the market. Around those buyers as well, I think this chart I wanted to show because you often hear about Microsoft or EasyJet or some of the larger retires in the market, but what this is showing is the number of first-time buyers that are entering the voluntary carbon market. And I think the encouraging trend here is that it is upward since 2022. And over the last 18 months, on average, about 325 new buyers are coming into the market, showing there is a breadth to that buyer demand that is coming in. And the last slide around current market activity that I wanted to share is around sort of the diversification of registry. So if we go back 20 years in this space, the vast majority of credits were issued and retired via a very small number of registries. But what you can see over the last 5 to 7 years is a much broader group of registries coming in and issuing and retiring credits. Here at Allied Offsets, we partner with 31 different registries to get data and put into the platform, and we're constantly looking at new registries to insert as well. So this is definitely an area that continues to diversify, and I think we'll dig into a bit more of that as part of the webinar as well. So if that's kind of where we are currently in the voluntary carbon market, I also want to talk a little bit about where we see the market going. So Allied Offsets has generated a forecasting model, a supply-led forecasting model, which allows our users to look at supply, demand, and prices into the future. What is also interesting is we can start to look at what's the required investment to generate those credits, what's the potential revenue from those credits, and then what are some of the co-benefits that come out of the generation of those credits, so employment being one. So if I just sort of bring that up, so our market forecast around prices and buyers, one thing you can see on the left here is where we see a lot of the demand coming from in the voluntary carbon market over the next 15 to 20 years. CORSIA, future compliance markets, SBTI and non-SBTI targets. And then on the right-hand side, you can see forecast market price by 3 different scenarios: high, medium, and low. I think the point I want to make on the high growth scenario would mean that there are more corporations setting targets and getting involved in the voluntary carbon market. So that's where you start to see those prices increase with the higher demand from those corporate buyers. At the end of the day, the voluntary carbon market is going to be successful from a dollars and cents perspective. So one of the things we try to articulate with our forecast is what is some of the excess profit potential for projects within the voluntary carbon market. And this is looking at the profit above and beyond the cost of setting up and operating those projects. And what you can see is here in the next 5 years, there is a significant opportunity for excess profit potential in the voluntary carbon market. And then the last 2 slides I have here are really put in because, as we've been working with more and more governments trying to understand Article 6 and the PACM mechanism that's going to be in place, they want to understand what's the revenue opportunity in their specific country or within a specific sector of the market. And what our model allows us to do is look at what is that potential revenue opportunity. This is in a medium growth perspective, but you can see those numbers do start to add up from a projected revenue. And if we went into the high growth, obviously they would be a bit higher. And then lastly, around employment opportunity for the VCM. So it is interesting to look at profit and revenue, but one of the areas that people have been most interested in is what is the potential for employment around the voluntary carbon market if these new projects are started and operated. So this is another quite an interesting stat. So I wanted to provide that picture because what we've done is done a bit of a compare contrast versus where we're at today, where we believe the market could go. And I think the conversation today is really going to be about how can we facilitate some of that growth in the market. Before we get into the conversation, we discussed as a team last week, and we thought it was important to establish some details around, terminology to make sure we're all speaking the same language. In the infrastructure part of the conversation, it'll be really important to have these distinctions. The first one around project developers, so they design projects that remove or avoid greenhouse gas emissions to generate carbon credits. These are fairly simple definitions, which we will dive more into, but just to give us a basis for the conversation. Standard bodies govern carbon standards. They provide methodologies, rules, and requirements to certify and issue credits. The registry provides market infrastructure, creates and transfers voluntary carbon credits, and tracks and records retirement data. And then the validation and verification, or VVBs, independently assess project emissions, reductions, or removals. Most of these firms are required to be ISO 14065 accredited, but it will depend on the registries that they're partnering with what is required of them. So before we jump into our questions, the last thing we need to do is do our introductions of our panelists who have been waiting patiently for us, so I appreciate that. And the first introduction that I have is for Dina. And Dina provides, and I'm going to do the introductions in the interest of time, so apologies for that. But Dina provides clients with legal, regulatory, and business advice on commodities. She has over 25 years of experience in commodity markets and 18 years of senior management experience focused on energy, metals, agricultural, carbon, and sustainable commodities. She structures transactions, develops carbon and sustainable asset platforms, and provides business-forward regulatory and commercial advice. Dina, thanks for joining us. It's good to see you.
Glad to be here.
Yeah, thanks, Dina. Next, we have Ant Stevens from Northern Trust. With 25 years in financial service, Ant is part of the Digital Assets and Financial Markets Group at Northern Trust, and he manages the Digital Assets and Innovation team. Last year, Ant oversaw the successful launch of Northern Trust Carbon Ecosystem, a blockchain-backed platform which allows institutional buyers to digitally access carbon credits from leading project developers. Ant, nice to have you here. And finally, we have Cornelius next, who is the VP, Cornelius from Bayer Crop Science. He is the VP of Global Carbon Operations with over 15 years of experience in strategic finance and project management. He shapes and scales Bayer's global carbon operations to be a clear leader in the space and provide the transition and promote the transition to regenerative practices in agriculture. And lastly, we have Andrew Howard from Vera. Andrew is the Chief Strategy and Policy Officer. He leads Vera's engagement with external policy developments and works to ensure Vera's programs are attuned to market and regulatory needs. He has over 20 years of experience developing climate policy and carbon markets in national governments, with business groups, and with the UN Climate Secretariat. So very nice. So welcome all of you. And what I'm going to do now is stop sharing my screen, and hopefully we'll have you all on there. So welcome. And now we're going to jump into the panel section of the webinar. And what I wanted to do is we're going to look at three main sections, as I mentioned at the beginning: infrastructure, digitalization, and commoditization. So I would like to start out with VCM infrastructure. And my first question is for Andrew. Andrew, looking at how carbon credits are created, issued, transferred, and retired, can you kick us off with an overview of how this happens at Vera? And Andrew, you might need to unmute yourself. Apologies.
So where do I pay my? Is it a $5 fee or $5 fine or? Okay. Yeah, happy to jump in on this, and a pleasure to be here as well. Thanks very much for the invitation and the opportunity. So, I mean, I think in talking about where the state of play is on carbon credits and how they're generated and used currently, I think this is something which is familiar to a lot of people on the webinar already. To go through it briefly, I mean, I think a lot of it really has its roots back in the clean development mechanism, which was done under the Kyoto Protocol. So that's going back quite some way now, a couple of decades, in fact. But that was really where the roots of the system took hold. And when you look at the way credits are generated today, they're actually not that dissimilar from back in the day, right? So there's a project cycle in which first of all, projects have to be registered. In order to be registered, they have to demonstrate that they meet requirements which are set out. Those requirements cover a whole bunch of things. I mean, it covers obviously some of the quantification issues, and there needs to be specific methodologies for how to calculate emission reductions and removals. But there's also a lot of other requirements which I could kind of put into a kind of community acceptance or environmental and social safeguards camp, because there's a lot of features of a project which are not just about how many tons of emissions are being reduced or removed. It's also got to actually fit in with the community, and I think that's taking an extra hold right now as well. But once the project's registered, then it goes through monitoring and verification. Of course, we have third-party independent verifiers come in for this. That is all done according to methodologies which have been approved in the past, and these methodologies also are in a kind of continuous improvement cycle where we're making sure that they keep up to date with science and technology and the like. But once all that is done, then you're able to actually have a credit which is issued. The way it's done today is these are issued onto a registry which typically belongs to the crediting program that's done the MRV cycle, the monitoring and reporting verification. So in our case, Vera has a registry. It's a registry not only for carbon credits under the verified carbon standard, but also holds assets under our sustainable development programs, under our plastic programs, things like this. So the credit gets issued. It then can have a life of its own to a large extent, where, out in trading markets and so forth, it can be transferred back and forth. And ultimately, when the credit is used against a target, for example, then it's retired on our registry. And that retirement step is really crucial because it kind of marks the credit as having been used for the environmental purpose, and it's no longer available to anyone else. So, traditionally, a program like our VCS program has served a voluntary market. So obviously, where a company has earlier a wish for carbon neutrality, and today much more in the context of net zero decarbonization that it's doing, they can use credits in order to perform some of the action that they're undertaking. It's increasingly being used in compliance markets. So we're doing a lot of connectivity with other registries in countries, so actually government programs. So it could have an emissions trading system or a carbon tax where the credit can be used. And there's already instances of this. I think the first one that we've had running is with South Africa, where credits from the VCS program can be used inside South Africa by a company which is subject to a carbon tax, and they can actually surrender credits in place of in lieu of paying a carbon tax. To some degree. When we think about sort of more recent or more modern implications and implementations of that, a good example of Singapore. So Singapore has a very open framework under its carbon tax. It essentially allows a number of different independent crediting programs to supply credits into the Singaporean carbon tax. And the way that works is you may have a project which is running in Senegal. It gets registered under the VCS. The credits get issued onto our registry, but then they can be retired against the Singaporean carbon tax directly on our Vera registry. So in this case, there's a particular retirement reason. This is what we call it. So it indicates, the purpose for which it's been retired, and we then communicate with the Singaporean carbon tax authorities so that they know which of their covered entities is actually surrendering a credit. So that's a kind of very open way that they're moving forward on this. And of course, when we look at the way that credits are being used for voluntary markets and compliance markets, we're very much of the view that there's only one kind of credit, and the quality or the integrity requirements for that credit are the same, whether it's being used by a company for a voluntary purpose or towards a government compliance program. It's the same credit. So the distinction between voluntary and compliance markets is very much on the demand side, is what's motivating the actual purchase in the retirement. It's not on the supply side at all. And so then when we look at how those, I mentioned before, there's kind of another life in between issuance and retirement of the credit. These credits can then can live a life outside of our registry in many ways. Certainly, there's the first offtake where an investor in a project is able to take credits. They are the owners of that credit. There are also marketplaces and brokers and for OTC arrangements, but there's also exchanges whereby the credits are bought and sold. They typically operate because all of these different players have a registry account on our registry. So the credits are within that account, and then it's up to an exchange, for example, to be able to shift the ownership around. And as and when that ownership or perhaps the retirement of a credit, that will have implications back onto our registry so we can perform the retirement function. But between that issuance and retirement stage, there can be all sorts of trading and changing of ownership of the credit. So I think we'll come later on to talk about improvements in the system, and there's certainly a lot of scope for that. But I'll come to that later.
Thanks, Andrew. Appreciate that comprehensive view of the sort of life cycle of the carbon credit at that point. And I'm going to turn to you now, and I think Andrew mentioned in his setup that this has been going on in a fairly similar way for the past 20 years or so, obviously with improvements and enhancements as we've gone. But at Northern Trust, you've taken a bit of a different approach, and it'd be great to hear a bit about sort of what you're doing at Northern Trust.
Of course, thank you. Thank you, Andrew, for setting that up as well, for that intro as well. Yes, so Northern Trust, I think a bit of background as to what we are, because we're probably quite different in the market compared to the current participants. So we are a custody bank based in Chicago. We look after just under $17 trillion of assets for our clients, and our clients are predominantly high net worth wealthy individuals, family offices, and then we provide a lot of middle office and back office services to what we call our asset servicing business, which is pension funds and institutions. We look after people's assets, and what we do is we ensure that the asset is owned by the individual, and then we ensure that it's transacted for cash so that they get paid before the asset moves. So as a bank, we've been around for 135 years. We're very important within the infrastructure of the financial market. So when we looked at the market around the voluntary and the compliance market, the regulated market, we saw that in order for it to scale to the size that everybody would want it to allow it to get to the point where we all think it needs to be. But we felt that that market needed to look a little bit more like the existing financial markets that exist today, and the participants within those needed to act a little bit more like the market participants do today within the financial infrastructure. So as a bank, we do a lot of transactions every day. We move a lot of assets for cash. We saw the need within the voluntary market to be able to put in place an infrastructure play that would allow for voluntary carbon credits to be embedded into a financial asset within our structures. So taking that non-financial intangible commodity and turning that issuance of that credit or of the emission claim into an asset that could be held within a custodial structure. So we spent a lot of time working to get that structure right, talking to the regulators with a lot of external legal advice to ensure that we could turn that carbon credit into a financial asset within our platform, or embedded the emission claim into an asset on the platform that could be treated as a financial asset. That asset is owned by the project developers to start with. They can then physically settle that transaction, move that commodity from their own ownership into the ownership of the buyer, and that we can manage that through a physical delivery of a commodities contract. So the reason we saw this as being important, Brad, was to be able to put in place the same structures, accountability and ownership that we have in our existing markets, which is partly regulated and partly that's how the market has developed over the last 100+ years, to get to a point where we can provide that infrastructure, where we can guarantee ownership and then transfer that ownership in what we would call DVP, so delivery versus payment. So money arrives in the project developer's account a fraction of a second before the asset is transferred out. So very important for us to be able to try and embed a more financial structure into this market to allow it to grow to the size that it needs to.
Okay. Thank you for that, Ant. Really useful to sort of see the different approach and sort of the reasons why you did that. And I wanted to come to Cornelius now, and I think Cornelius, as a project developer, we speak to a lot of project developers here at AlliedOffsets as well, and there's different challenges and opportunities that they face when bringing credits to market. So it'd be great to hear a bit about your experience and sort of the key points around ease of transaction, some of those elements that you wanted to bring to life around your interactions with both from a registry perspective or with Northern Trust.
Yeah, thanks, Brad, for having me. And yeah, maybe also a little bit of background. So basically, I'm part of the ecosystem service team here at Bayer, where we basically started developing carbon projects in the ag space back in 2020. And the main goal is really to help more and more farmers transition to regenerative practices, be it no-till systems, be it cover crops, but then also looking into rice in Asia, enhanced water management, which we are looking at. And so today we basically are active across the globe in several different countries, and we have several projects either listed or currently under registration, or also actually already issued credits. So we, for example, have a VM42 project here in North America. So we are working with Vera on this one. We have a project under the Nori croplands methodology, which we launched in 2021 and actually brought now over to Northern Trust to transact basically the existing credits. And lastly, we are working with Gold Standard currently in India, and there we also foresee to launch a new project under the new rice methodology for Vera. What we see is that the space gets quite complex, and I think your slide has shown it. The fragmentation is increasing. We have more and more registries in the market, which actually oftentimes makes our life a little more difficult, because we are currently, for example, dealing here with 3 standards and 3 registries, so to say. And every registry functions a little bit differently, right? Everyone has different processes. Some are very manual. Some are actually trying to implement more digitized processes, such as Gold Standard, where we basically now submit everything in a digital platform. In the past, it was shared via secured SharePoints, quite cumbersome. But also these processes often lead to very long timelines, right? I mean, I think if you talk to other project developers, from a project listing to the first issuance, in many cases, several years are passing, right? Which actually represents a significant cash burden for project developers and actually hinders them to scale the projects quicker. So I think one weakness today, or maybe not a weakness per se, but I think one downside really is this long timelines to develop projects and actually bring them to market. So we really hope that there's more harmonization going in future to allow us to actually accelerate some of these timelines. And I think Anne talked about it a little bit, the settlement aspect, and that's what we actually really much like with the Northern Trust platform, is that basically there's basically a real-time generation and transfer of credits happening, as well as when the settlement, right? Very often, if we are transacting credits on other registries, we are dealing with very long paths and basically have to agree on different payment timelines. We need to agree on when do we actually transfer or retire the credits. This is all taken care of by Northern Trust, basically in real time, right? The credit transfer happens at the time of payment, which also de-risks us, right? Because ultimately, it helps us to get basically the money in from the current credit sales much quicker, and also gives us some more confidence, right, to really transact in a digital form there.
Great. It's always really useful to have the project developers insight into that, because you know the pain points and sort of what the different groups are doing to address those is always really interesting. And Dina, I think Cornelius touched on something there where I had you coming in a bit later, but hopefully I'm not putting you on the spot. But I think he talked about sort of the speed and the ease, and I know you've been working on sort of helping to standardize contracts and looking at that piece of the puzzle. Is there anything that you want to add to this piece of the conversation? You might be on mute. Don't know if I can unmute you, Dina. Let's see.
Thank you so much for doing that. Yeah, I don't know why I wouldn't click the button on my phone. So I do think that Cornelius makes a good point, and it builds upon what Anne and Andrew are saying. You know, Andrew started off by saying, you know, he believes that the demand side of the market is going to be the driver. And I do as well, right? I do. But just to marry that a little bit with what Cornelius and Anne had said, and that is, and to answer your question about streamlining and efficiency and effectiveness, right? The buyer is always the goal, right? Because we have to make sure that we have a real, transparent, quantifiable commodity and asset, right? And that is what the buyer needs. But the project developers, if we're going to give the buyer what they need to make sure that they're able to get paid. They also need to be able to make sure that they're able to finance their projects. And so at this point, we do need things like Cornelius and Ant and Andrew were saying. We do need things like better settlement with the payment for the credit. We do need things like digitization of the documentation and the requirements that are required, like to be delivered by the project developer, right? Because you're talking about mostly someone who is possibly a startup or that needs funds. And the easier we make all these things, the more projects that they will be able to have. Also, the more we use technology to digitize the documentation and the information that project developers upload to the registries or to the platforms, we're also able then to provide the buyer with more information. So it's really all connected. And templates and standardization, I wish we could do more of it. I do think that will help. I think that as the market is evolving, we're beginning to see more and more standardization in the contracting part of the market. But I'm not so sure that, you know, I think the most important part is what the folks before me were talking about, which is, you know, using technology to make sure there's payment, using technology to digitize the documentation, using technology and platforms to make sure that you can actually, as the buyer, very quickly see what you're buying. So that gets the project developer money quicker, and it gets the buyer to where they need to be quicker without having to hire, you know, lawyers. I'm a lawyer, I get it, I should never say that out loud, but that I think is important, and that's what it's going to be even more important as the market evolves.
Great. Thank you, Dina. And that leads me well into the next section, which is digitalization. I think each of you mentioned it at different parts of the conversation, so that's really useful. I think, Ant, I'd like to start with you because I think when we did our prep session last week and I brought up the term digitalization, everybody had a slightly different view of what that meant to their part of the puzzle. So Ant, if you don't mind starting with your view on how Northern Trust is digitalizing, and then we'll move on to the other panelists as well.
Yeah. So, so the way that I would see digitalization, it's not one little thing, right? We all need to digitalize our parts. The easiest way to do it is if you make it digital at source. So the information coming in at the very beginning of the process, if it's digital, running the rest of the solutions in a digital way is a lot easier. So if you are having to add in a digital piece in the middle, so we are in effect a registry, we're a recordation site where we're then doing settlement and transfer of cash. We're bringing some data in and we're making it digital at source. So as it comes into us, it's becoming digital. That means all of the rest of my downstream processes can be automated using business logic to manage the downstream process. It gets harder the longer you've been in the business because you've got more older functions and tasks that you have to replace. So as a new player in this space, it's sort of easier for us. We run a digital platform for all of our digital assets, and carbon is one of the digital assets that sits within our digital platform. So we can run the life cycle of assets from creation to the point that they are, in this case for carbon, retired, and all of the different corporate action functions that sit in there. But for all of us, we'll also see digitalization has been something slightly different. It might be digitalization of the verification process through a digital MRV. It might be digitalization of the onboarding of projects and the ongoing monitoring of them. So I think when we all talk about digitalization, we're all talking about something slightly different. But really what we're all trying to do is work out how do we get the correct, verifiable, accurate data in one place that can then be used to manage downstream functions. And we very much see the need of that at the earliest point as it comes into the bank, so that we can then manage that through the process. So we've got very little operational staff because we can run the whole thing through sort of business logic and smart contracts. Where I see digitalization for us specifically is when we receive data in, we can either receive data in, and at this point I'm talking about the verification report coming to us so that we can record those assets within the platform. We can either take that through a paper copy, which is this, I guess, the more traditional form of verification. You've received your verification report. That is your issuance of your carbon credits. Or we can receive data in real time through a set of IoT devices coming from either the project developer or the digital MRV. So we've got a number of projects where we're now set up where we're receiving digital data, which will either record the capturing of the CO2 or the verification of that CO2 process, depending on the project developer.
Thank you, Ant. And then, Andrew, I'd like to come to you. And I know Vera's been doing quite a bit of work around the digitalization agenda as well. So could you talk about what you're doing in that space and sort of how you define digitalization?
Yeah, thanks, Brad. Yeah, indeed, as Ant has been saying, there's different forms of digitalization, though, we have been very focused in the last years on digitalizing the generation of those credits. And, there's a number of different steps to that. I mean, first of all, the actual projects themselves, we're moving now to digital creation of projects in the first place. So there's no longer a need to submit a PDF document of the PDD form, but actually it's being introduced into our system via a web interface. So what we're seeing is the actual underlying data, and it makes it much more easy to be able to manage this going forward. So there's the project itself, then the methodologies themselves are being digitalized, and that means essentially that it's possible to then calculate the emission reduction removals through these digital tools that we're creating, instead of having to go through the whole cycle that we're used to now. And that leads us into the whole digital MRV space. And as Ant says, the sensors that you can have running, which are providing data if necessary in real time. It doesn't have to be real time, or remote sensing as well, which leads to an easier issuance. So it makes the system not only more efficient, but it also makes the system more reliable, because once it's set up, then you can have much more confidence in it. And in terms of what that means for the verification process. I think, we're moving much more to a concept that it's the platform itself which is being certified, and the platform which does all of those calculations. But I think it is very important still to remember that, there are, and I said this right at the beginning, when you look at registering a project, there are many things involved in that project. It's not only the quantification aspects, there's also a lot of things which I termed before as community acceptance or, environmental social safeguards. And these are also incredibly important. And, I think the term has been raised around real-time issuance of credits. And ultimately, of course, it is possible to get to a real-time issuance. I think in practice, we would see it more as a high-frequency issuance of credits. And we have projects which are talking to us right now about, being able to issue on a monthly basis using DMRV. And that I think that's very key. But what is also really important is to be able to ensure that the credit which is issued has all of the confidence and all of the trust that's embodied in an accrediting program, with all of the requirements and all of the different aspects of the verification. I think if you move too quickly to issue a credit, then inevitably you're issuing the credit on some sort of ex-ante basis, where you have to go back later on and do some further checks to make sure the project is actually meeting all the requirements and has been for that particular short monitoring period. So, I think it's not necessary, I think, for most users to move to real time as such. You might be able to get to something near real time, and that may be a month. And that's going to depend on a lot of what the size of the project is and what sort of use there is. I think one of the key developments we've been looking at and working with has been the work under UNIDROIT. I don't know if you're familiar with that. It's the International Institute for the Unification of Private Law, and they've been running a working group which is basically trying to standardize the legal definition of a credit. And what you have currently is different countries will have a different definition of a credit. And it's interesting that we're, 20, 30 years into the market now without actually having this standardized. But what UNIDROIT is trying to do is to get a standard definition of what a credit is. They're heading towards a definition of it being an intangible asset, which I know for many people is, perfectly obvious. But the work is really about getting a standard definition across the world. So they're bringing out their results towards the end of this year. And the work then is to get this definition imbued into the legislation and regulation, which is running all over the world. And that is very key, because I think that creates a much stronger basis than we have today for being able to do things like recording the ownership in a standardized way globally. We'll be able to move also to supporting trades much better, and the kind of settlement features that we're talking about. This becomes easier when you've got the whole globe working on the same sort of credit definitions. Also, key things like registering security interests on credit issuance. So that's really key, being able to raise loans to facilitate that sort of thing. So there's certainly a lot that the kind of financial market thinking needs to bring into existing carbon markets. We're working with partners in order to be able to achieve that. We have very much a view that, what we're looking at as an ecosystem in the market. We as Bearer don't necessarily need to provide all of those components, and maybe we're not the ones to provide the custodial records and services. But we need to be able to work with partners in order to do things like that. And I think Northern Trust is an early mover in that space. It's obviously working with particular jurisdictions, but we want to see that sort of thing expanded across the globe.
Great. Thanks, Andrew. And we're going to touch on a few of those bits around financial assets and commoditization. I want Dina to take that in a minute. But before we do that, I do want to go to Cornelius. And I think one of the things we heard from Ant is getting data early on and digitalizing that data and making it more streamlined. Andrew's talked about that as well. I guess my question as a project developer, are you up for that? Is that creating more challenges for you? How do you feel about sort of digitalizing that data and providing that early on in the process?
Yeah, I think what we are seeing is that it significantly simplifies our work. Most of the data which we have is in digital form, and if we can actually submit it also in the digital form, there's definitely an advantage. So I think we are seeing digitalization basically across the whole project development chain, right? From basically standards and registries, digitizing some of the processes with DMLV solutions and submission of electronic documents, but then also looking, for example, at Northern Trust to settlement transactions on a digital platform, which also offers additional opportunities for us to attach additional data points to the credits itself, which we already actually did with Northern Trust. So I think there are really a lot of benefits from a project development perspective.
Great, thanks, Cornelius. And Dina, before we jump into the commoditization piece, we had a good conversation on this topic around data, digitalization, and transparency last week. And I think you brought up, I thought you brought up a good point around it. You know, it's not just transparency, but it's the quality, the depth, and the type of data. And anything that you'd like to add on that topic as far as the digitalization agenda that we just discussed?
Yeah, you kind of set me up. So I do think that it's important. And here's why. If the market is going to grow, the things that Ant and Cornelius and Andrew are talking about are super important. But we do need to have a market where we know the price of things and we know the value of things. Okay, Andrew, perhaps we don't know what that thing is, although I am of the camp that it is an intangible personal property, right? That can be, bought and sold and, et cetera, used as collateral. But one of the major issues that I see when I represent both buyers and project developers is they always ask me, what is the credit worth? What is it worth? So one of the benefits of the digitization at every level, like what Ant was talking about from, beginning to end, and what Cornelius was talking about the digitization of his data and being able to put additional attributes on the credit itself, gets us to know what the credit is worth. And it's important that we know what the credit is worth, because once we know what the credit is worth, we're able to have price transparency. With price transparency, derivative markets can grow. When derivative markets can grow, we'll be able to have more project developers perhaps get debt, perhaps hedge their risk, which will make them have more capital available to operate, or maybe even put towards additional projects. So all the digitization is important for all the reasons that those folks, my colleagues on this call, spoke about. But even further, for the market to develop, it's that transparency, like you were talking about, Brad, that will lead to price discovery. And I think that is going to be the next sort of step here.
Great. Thanks, Dina. And don't go too far,
You're
because
welcome.
I'm going to come back to you pretty quickly here. So the last topic that we wanted to cover is really, and it's a big one, so we've got about 10 minutes, and then I am going to take a few questions because we do have a number that have come through, is around commoditization and carbon as a financial asset. And I think you just touched on a few things around collateral and what you can do if we consider it as such. So can you talk a bit about the work you're doing, maybe tie it to what Andrew was talking about around, carbon as an asset or as a commodity, and where we've gotten to with that?
Yes, so happy to. So carbon, in the form of a carbon credit, is the package that we create to almost commoditize the removal, like what Ant and Andrew were talking about, right? So what you have from the project is you have a raw removal of one of the 6 greenhouse gases, right? And each of those 6 greenhouse gases has a different carbon makeup, right? So what we do in the voluntary carbon market, and Andrew and Ant and Cornelius is right, is we then commoditize that. We package up that raw removal or the raw reduction into packages of credits, which is 1 metric ton of the carbon dioxide equivalent. So, a molecule of methane, I think, has 5 carbon molecules, right? And so you break them apart, right, into CO2, right? It's 1 carbon you pull apart and then you put it with 2 oxygen, right? That's a CO2. And so your carbon credit is commoditized because each credit represents 1 metric ton of the carbon dioxide equivalent. But what's beautiful about this market, and what we've already talked about, is a little bit different when we commoditize, right? Because the CO2 equivalent from a removal project in the United States may have a different value to someone than a CO2 removal project in a different part of the world. And when you digitize, you're actually able to see perhaps jurisdiction like that, right? And so for me, it doesn't make it not a commodity. It's almost like you would with any other sort of commodity. It becomes like the specification, right, of the commodity. You have light sweet crude, you have removal, or you have a reduction credit, right? And so that's what's happening when we're beginning to commoditize and when we see the commodity in this market. You can buy, sell, consume raw removal. Like you could consume a methane reduction or a methane removal if you like. It's just hard to do because then when you're trying to consume it and tell the world that you've consumed it and take the claim on your accounting or your sustainability report, the way we have to tell the world is so that it makes sense to everyone is to then convert it into its CO2e. So the market is making that easier. So you buy the credits already in the CO2e, you retire it, as these folks have told you, you've consumed it, and then you immediately can take that. You could make the claim because you've retired it on your sustainability report, which is governed by usually the greenhouse gas accounting protocols. And by doing all of this and commoditizing, we're making it easier for this asset to be collateral on loans. We're making it easier to know, again, the digitization makes it easy to know what the value is, right? The digitization and some of these ecosystems and platforms will allow a lender to step into the shoes of the project developer. And we used to freak out about that. Like years ago, we used to be like, we can't have anybody step into the shoes because then you wouldn't know whether the person who made the credit, actually still owned it. And does this create a slippery slope where I don't know who owns this credit anymore? And am I buying something that someone hasn't already consumed? But all these things coming together, the commoditization, the realization that it needs to be collateral on a loan, the realization that, if you have a bank that can create a custodian type asset where you have more financing opportunities outside of just project finance, all these things tied together is what's making this market so dynamic and what's making the market so interesting as we begin to continue to commoditize in its own way and in a different way than any other commodity.
Great.
And I hope that answered your question.
Yeah, no, that's great, Dina, and I appreciate that. I think I want to use a couple more minutes just to get everybody's sort of perspective on what Dina just said and potentially the implications for your part of the value chain. So maybe if we start with Cornelius, what Dina just described, how do you see that in, impacting you specifically and project developers more broadly? And if we can keep the answers a bit short, then we have time for Q&A from the audience as well. Cornelius?
Yep. Yeah, I think what Dina said, I think what the digitalization allows us really to is to attach additional attributes to a credit, right? I mean, we have it, for example, also with Vera, we have SD Vista, we have CCB, right? Really covering the core benefits. What we are currently doing with Northern Trust, for example, the NORI credits, which we have on the platform, we actually attach the state attribute to them, because what we've seen is that a lot of offset purchasers were quite interested in actually maybe supporting projects in their backyard where their operations are or where their headquarters is. So we are basically now able to sell credits created in Illinois to an Illinois company, which actually creates additional value for the offset buyer as well. So I think that's quite exciting what this allows us to do going forward.
Okay. Thanks, Cornelius. And Ant, how about you? Any reflections on what Dina says and how it enabled the work you're doing?
Yeah. So I'm probably unique on this table because we're sort of highly regulated. As a bank, we have many regulators that are interested in what we do, and I can only do certain functions where I have to meet certain regulatory rules that I have to follow. So this journey for us, and this is where Dina and I have worked quite closely together, has been around ensuring that we are very clear as to what this asset is and how it's defined under the existing rules in the US. Andrew's point, the world has got lots of different regulations around what carbon is, and it's a different asset class in each place. Some don't recognize it as an asset class. Some it's a non-regulated asset, like in the UK. In the US, we think we can make a claim that it's very similar to it. It is a commodity, a non-financial environment, intangible commodity. That being the case, we've got some structure that we can work with, and then we can start working within the law and the regulations around ensuring that this asset, as it develops, can be treated in such a way that you can then do other things with it within the rules. That's really important to us.
Great. Thank you, Ant. And finally, Andrew, your view on that?
Yeah, I agree with the things that have been said already. I think one point I would make is that, we do have this data now. It's just that it's more difficult to get at. So it's not immediately digitally available from whatever interface you're dealing with. Instead, you have to look at the serial number and look at and follow the links back to the projects. There you'll find all of this information, but it's much less accessible. So I think we really look forward to getting the information out there much more. We think that the challenge is really in, as we kind of reduce all of that mass of project information down to specific attributes, we need to be looking at basic things like project type and vintage and location and all of this sort of thing. But we also really think it's fundamental to bring into that information on, how is it meeting sustainable development requirements in the country? Is there a benefit sharing aspect? So, we mustn't lose sight of this sort of thing. And that just brings me to a last point, and that is that in all of this, it is really important that a buyer and investor knows what they're buying and investing in. And, the market has been shifting more and more towards what's coming through in the ICBCM, the core carbon principles, and the approvals that have been given there. There's a relatively limited set of programs which have been approved so far, and there's a limited set of methodologies which have been improved so far. That work is ongoing, and there's more and more programs and also methodologies coming through. But it is really, really key that in all of this, we don't lose that connection to the actual fundamental quality and the integrity of the credit. And the reality is that has not been demonstrated across the entire market as yet. I'm not saying it's not there, but it hasn't been demonstrated in the way of making it clear for all investors and buyers. So that's another consideration that needs to be really front and center of the way we move forward on the market. So I didn't want to end the webinar without saying that as well.
No,
Brad, don't kill me. Don't
Go
kill me,
ahead.
but I did forget to say one thing, and then we'll go to the questions.
No worries.
So we were talking about the evolution of the market and the next phases and what digitization will do. And I know you're called Allied Offsets, but I do believe that this is going to lead towards more and more inset type projects, inset type measurements, and more opportunity for us to do things to help the climate while making money. And all of that is going to be an important part of the market. So you may have to change your name in a year or two.
Hey, thanks, Dina. It's a good.
You're welcome.
It's a good point to make. So I am going to get to a few questions now. And just for everyone that's asked a question that I may not get to, we have had the panelists agree to working through the questions with us. So we will respond back and send them back out. But apologies, we aren't going to be able to get to all of them. I think there's one that's catching my eye around fungibility. We just talked about commoditization. And the question is, how can the market and market facilitators improve fungibility across the range of carbon credit types? Without better comparability or standardization in terms of durability, risks of reversal, et cetera, how can you evaluate a credit's value? And I think, Dina, this was kind of going to the point that you made towards the end. Do you want to start with that, and then we can have anybody weigh in that may want to do?
Yeah, so I think it is a great question. And we think about this all the time. Again, as a lawyer that represents both buyers and project developers, we think of this all the time. The answer is going to be, in my opinion, it is going to be sort of like what Cornelius was touching on. We are going to use technology to take that CO2e, that metric ton of CO2e, and embed what we would call in other commodities specifications. So, is it a removal? Is it a reduction? Is it a removal that's, carbon capture that's sequestered, or is it a removal with a tree? The jurisdiction, the vintage, all these types of attributes will be attached to the CO2e, and you will know, just like with anything else, at some point it's all going to shake out, and we're going to see that we're going to start seeing groupings, right? Where removals may be worth a certain amount, where reductions are worth a certain amount, where avoidances are worth a certain amount. And I do think that that's what's going to happen. And so For it to be fungible, we will use digitization, we'll use technology. We are going to start using more and more probably these measurement tools, right? Because, you know, it's not going to be about necessarily the methodology. It's going to be about the quality, transparency, quantity of the measurement and the location and the type, whether it's removal, avoidance, or reduction. And that's what I think is going to happen there to make sure that we continue to move towards commoditization and fungibility.
Great. Thanks, Dina. Andrew, I think you've come off mute. So Andrew, do you want to weigh in as well?
Yeah, just to jump in as well. I mean, I agree that one of the real keys is the attributes that we're going to have. I think that those attributes need to try and bring us together so that we understand you know, more distinct differences between credits. I don't think we're going to get to the point, and nor do we want to get to the point of having every credit being exactly the same as each other in terms of the peripheral benefits and the sustainable development and the, you know, the which country it's benefiting and that sort of thing. There's always going to be those differences in values, but it's going to be important that those get built in via attributes. And you know, just to go back to my last point as well on ICVCM, I think one of the issues that the market has really struggled with in the past is having a common understanding of what it means to have a high quality credit. And what ICVCM is trying to do is to build in a minimum level of quality, and then allow the distinctions between projects and between programs and between countries and all the rest to be built on top of that minimum level. So I do think that one of the attributes that needs to be right there front and center on these credits needs to be whether it's CCP approved or not. But that'll be you know, an important foundation on which we can then build the kind of structured differentiation of credits that we need above and beyond that.
Thanks, Andrew. And I was going to try to squeeze a few more questions in, but I'm going to be respectful of everyone's time because I'm sure lots of people have meetings in 2 minutes. What I will do in the remaining time is first offer a big thank you to the panelists. I think it was a really good conversation. We covered the 3 main areas that we wanted to, and I think that hopefully the audience members found that very useful. I will say I saw some really good questions, so we will be sending them your way for your answers as well. And secondly, just a big thanks to the audience members, and please feel free to reach out with any questions that you may have, and we can funnel those through. With that, I will say thank you, and everyone have a really good rest of your morning, afternoon, or evening, depending on where you're at. Take care. Bye.
Thank you.
Thank you.
Thank you.